This is the Financial Beat, helping you hit all the right notes in your financial plan. So sit back as we strike up the band. The Financial Beat with Logan Sadler starts now.
Welcome to the Financial Beat, ladies and gentlemen. Logan Sadler is back on the radio with another great show to help you get to and through retirement. My name is Ron Stutz, and Logan, how you doing, my friend?
Ron, I'm doing good, man. Looking forward to a good educational show here, and as I say, almost every week, it's probably my favorite time of the week here of my week is radio day.
Oh, my goodness, I am flattered. Thank you very much. Yeah. We're going to talk about getting you to and through retirement, and that's what Logan Sadler does so well for so many people. If you'd like to get in touch with Logan and the folks at Regari Financial in Hammett and Redlands, the number to call is 888-823-PLAN. That is 888-823-PLAN. Now, that will get you a discovery meeting. We'll talk more about that as the show goes on today, but basically it's getting to know you session, and it's not going to cost you anything and not going to obligate you to do anything at all. One more time, that number right now is 888-823-PLAN. Hey, got a fun fact of the week here, Logan. I know you're really into numbers and everything, and of course you would have to be into numbers doing what you do for a living. But, the number 1,000 is the smallest number that contains the letter A in its spelling. Have you ever thought about that?
I really haven't. That is a fun fact of the week there. It kind of got me thinking. I'm trying to run through all the other ones, and that sounds about right.
Yeah.
But I had never thought of it that way.
Yeah, I read that somewhere this past week, and I never thought about it either, but I thought it might be interesting to kind of throw it at you and see what you had to say about it. So
yeah, that's cool. That's interesting. I learned something today as well.
Yeah, fun fact of the week. So, you work with a lot of folks who live in Southern California, of course, and all over the state, and you've got some folks that you've helped who have lived in various parts of the country. And I thought it might be kind of fun to do this exercise in linguistics today, both inside and outside of the financial realm. You tell us which word or phrase you use in these situations and explain why the difference in terminology might be an important distinction to make on some of these financial terms. So, you ready for this?
Perfect. Yeah, sounds fun.
We'll just call this, how do you say it? So, okay. All right. Do you say, I think I know the answers to most of these questions, but I think it might be interesting to ponder. Do you say y'all, you all, you guys, use guys, or you'uns?
That's funny. I would say probably you all.
Yeah.
Again, I have a lot of clients out in Texas or Nashville types of areas or Tennessee, things like that. They might say y'all, but I typically say you all.
Yeah. Well, me too. Although a lot of people around me say y'all for sure.
Yeah.
and you guys. I sometimes say you guys. I never say use guys or youuns.
Nah, I would say you're right. I'd probably say you all or you guys are probably the two most common, I'd say.
All right. Well, let's talk about that. Is something that is related to the financial world. Do you say market crash, market correction, or bear market?
That's a good one, actually. I typically say market correction. And the reason why is because I think market crash is just meant to sound so scary, right? I mean, I think it's kind of used like, the market's crashing to cause panic, And again, now the market does go down very fast sometimes.
Yeah.
So it could be categorized as a crash. And bear market, some of our clients, they might not understand exactly the terminology behind that. Again, some clients do, some clients don't. So I just tend to stick more with market correction.
Yeah, and if you say market crash, it tends to alarm people, so.
Yeah, it just sounds scary, right? Crashing down. So, I like market correction. I think it's really more of the proper term to use when you look at what the markets do, right? They do over time correct themselves. So I like to use market correction.
I would certainly agree with you on that. How about yard sale, garage sale, rummage sale, or tag sale? Which do you say?
I typically would say yard sale, and I don't know why, but that's just kind of what I grew up hearing and saying. So I would say yard sale.
I agree with you on that one as well. Don't think I've ever said rummage sale in any context.
No. I might have said garage sale before. I typically just think of it as a yard sale because most of the time people don't actually do it in their garage, right? They typically do it in the yard. So I just think a yard sale.
Yeah, I agree with you on that one. How about junk bonds or high yield bonds? Which do you say?
Yeah, that's funny because it's hard for a lot of people to understand that is the same thing, right? Typically, I typically say high yield bonds.
Yeah.
But most of the common term that people understand is probably junk bonds, I would have to say, just because we might have heard that phrase more and more. Basically, again, what it means is just they're both junk bonds are just a high yield bond, right? They're below the credit rating of some of the other bonds that are considered higher rated bonds. So yeah, it's our investment grade. So yeah, it's funny. I would probably say high yield bonds.
Okay, we're talking about some more financial terms here. How do you say it? Stocks or equities? Which do you say?
That's actually a good one. I typically say stocks. Now, most people are if we're talking about ETFs or mutual funds, and we say, yeah, that's an equity ETF, for example. Some people would say, well, what are equities, right? And so, essentially, right, equities are the market portion of the portfolio. So essentially, they're either stocks or different things that are tracking stocks. So that's why I would typically say stocks, just because people tend to understand that more. Now, again, there's different ways to invest, whether that's individual stocks or different types of funds, whether that be mutual funds or ETFs. But I would say, just general conversation, I probably would say stocks.
Okay, it's pretty obvious what you're going to say to this one, I think, because we've used this term on the show a lot. Financial advisor, financial planner, stockbroker, or investment advisor.
That's a good one.
Yeah.
That's a good one. I think all of those are kind of a little bit different. You know what I mean? And a lot of people might not understand that, but I typically, our firm, we call ourselves financial planners. And what that means to us is that we typically go into a lot more than just, hey, here's an investment you should look at, but really, analyzing Social Security, long-term care, future tax implications and things like that. So, we look at a lot more broad scope rather than just, like a stockbroker traditionally is more of, hey, here's some good stocks or mutual funds you should buy from us. This could help you, right? Mm-hmm. Investment advisor, they might advise on certain investments and things like that. And same with financial advisor. It could mean similar things, but I definitely think financial planner is more of what we do by looking at the more broad scope holistic plan and trying to plug in all those outside pieces to fit the overall plan and not just picking investments.
Yeah. You're listening to the Financial Beat with Logan Sadler. We're talking about how you say things, and of course, where you grew up or where you live in certain parts of the country may change your answers to some of these. Logan, do you say soda, soft drink, pop, or Coke?
That's a good one. That's pretty easy for me. I typically say soda almost all the time. What do you say, Ron?
Soft drink.
Yeah, okay.
Isn't that crazy?
That's funny. Yeah, I hear it all. I have a lot of family from Maine and things like that, and it's funny because when they would move out this way, they would they'd call it go get your soda pop or things like that, and we just always said soda.
Yeah, and some people just use the term Coke in a generic way,
Yeah, even though they mean Mountain Dew, right, or Dr. Pepper, they call it a Coke.
Yeah, that's kind of crazy. Well, one more thing here. One more thing to ask you. How do you say it? Clients, customers, or families?
Yeah, that's a good one. We typically say clients here, and I can't tell you really the reason why, but we've just always categorized them there as clients. I think that's a little bit more intimate than customer.
Yeah, you wouldn't say customers. I don't think of them as customers at all.
No, I wouldn't either, and I think of them more as clients, and typically what that means to us is it's typically a deeper relationship than what a customer is, right? A customer is someone where typically they come in and they buy something from you, and it's very transactional. Is kind of how I think it, and not that that's bad, but in our business we tend to spend a lot more time and build a lot more relationships, and so we typically categorize everybody as a client.
Yeah, and certainly you take into consideration their families as well and their whole lifestyle. So.
Yeah, you're totally right on that.
Yeah. Well, it's been kind of a fun little exercise here, I think. And I know that you have a lot of folks out there who've been listening to the show for a long time, and they've said to themselves several times, one of these days I'm going to call Logan Sadler. He sounds like a nice guy. Why is it so important for them to go ahead and do that now and stop procrastinating?
Yeah, you're right, Ron. It's funny because we've met with a lot of people over the last few months that have been listening to the show now for 1 or 2 years and are just getting around to making that call. And a lot of them have waited to where, hey, I'm retiring next month, right? Or I'm retiring in 2 months. And I always tell people sometimes the more time we have together to, number one, build the relationship, get to know each other a little bit, but also it can make a huge impact as far as planning goes. Sometimes there's a lot of things we could do maybe a year or two ahead of time, or maybe even 6 months ahead of time that we might not be able to do, maybe maybe 3 months or a month out. So the more time you have, again, to build the relationship with us and us to build a relationship with you, but also it gives us more and more time to get to understand what your needs are, really get to the financial planning side of things, and making sure before you pull the plug to retire or before you get your hopes up and ready to retire, let's make sure everything is on track, make sure we've crossed every bridge, and making sure that you got a financial plan that's customized, that is tailored fit to really fit you and your family's needs to transition your retirement, and also to give you that confidence when you're ready to file the paperwork to get ready to retire, that you have the confidence to do so. So give us a call. Again, it's complimentary. I'd love to sit down, spend an hour with you, either in person or Zoom, and see if we're a good fit to maybe work together in the future.
888-823-PLAN. That is 888-823-7526. But it's easy to remember if you use the word plan, because that is so essential in any conversation about your retirement planning. 888-823-PLAN. Your number to call for Brigari Financial. Now, there are two convenient offices, one in Hemet, one in Redlands, and you can have a conversation with Logan Sadler that's not going to cost you a penny and not going to obligate you in any way, shape, or form. No strings attached, in other words. May start with just a phone call or maybe a Zoom connection, or maybe you might want to come into the office. Either way, it's a discovery meeting. That's what we call it, and you can get one for free. 888-823-PLAN. This is Ron Stutz along with Logan Sadler, and we'll have more coming up in just a moment. You are listening to The Financial Beat.
Do you ever find yourself skipping through countless songs trying to find the perfect one? Yeah, we've been there too, and know it can be frustrating. Much like skipping through the countless advertisements from other financial advisors, it can seem like there's so much misinformation. But here on The Financial Beat, you can rest assured we're providing you with the best information possible. So don't push skip on this show, because we have some important information coming up.
Welcome back to more of The Financial Beat with Logan Sadler, Vice President, Chief Investment Officer at Brigari Financial. And if you'd like to get in touch with Logan to have a conversation about your financial situation, isn't it about time you finally got around to making that phone call? The number is 888-823-PLAN, 888-823-PLAN. At Brigari Financial, remember, they have terrific partnerships with local CPAs, attorneys, real estate agents, mortgage lenders, and Medicare specialists to help offer you well-rounded guidance in all things financial for you as a client. And you can get a discovery meeting at absolutely no charge. 888-823-PLAN is your number to call to make that happen. I got a quote of the week here, and I know you'll enjoy this one since both you and I are big music fans. Quote of the week from Bob Dylan. And, well, I would do my Bob Dylan impression, but I don't think anybody wants to hear that.
I thought you were going for it.
Money doesn't talk, it swears. How about it? Really, that's something he really said. Money doesn't talk, it swears.
You know, and I normally I'm pretty good at transitioning these into what they're trying to talk about, but this one is kind of a tough one where maybe he's saying, you know, it's not like money doesn't, maybe like a conversation isn't, you know, super serious until somebody swears. I don't know, and maybe they're saying that, you know, money is real serious. I don't know. Maybe that's what he's trying to say.
Well, I didn't know half of what Bob Dylan has written in the past, you know. Anyway, so I mean, it's hard to tell.
I don't think he does.
It's hard. That's great. Yeah, I think you're right. It's, you know, he has written some crazy stuff, that's for sure. And I think he is a great songwriter. But boy, I tell you, when they wanted to give him singing lessons, he skipped out on that one. That's for sure.
Yeah. So sorry, folks, we couldn't make more sense of that.
Well, that was wishful thinking that we were going to be able to make sense of that. So let's call our next segment here wishful thinking. Sometimes people have some wishful thinking when it comes to their retirement planning. And I thought today we could talk about some of the things that people might think will be true, but could actually just be wishful thinking on their part. So you ready for this one?
Awesome.
Some folks, I'm sure you have heard some people say when they first come in to see you, not after they become a client, but I'll just live off the interest and never touch my principal. Mm-hmm. Is that actually realistic?
You know, it's something you hear all the time, right? And it's one of those things that we've heard for a very long time. And for some people, yes, it is very doable in some cases, but for the broad scope of people, no, it's not necessarily exactly how it's going to work, right? Now, does that mean you're not going to have any money left over when you pass away? No, probably not. You probably will have some left over, but it just depends on how you kind of go about that, because there's a lot more implications in things than people realize. So, let's just use someone has $1 million and they say, hey, I'm going to be a very safe investor. I'm going to put it in CDs and I'm going to live off the interest. Well, the problem with that is over a 10 or a 20-year time frame, right, or maybe even a 30-year time frame, your CD could be paying like it was a few years ago. It could be paying 1%. So that means, you're going to have, $10,000 a year to live off of on $1 million. And then if you have, a 2% CD, you're going to get $20,000 a year to live off of. So you got to kind of look at things more realistic. Now, of course, people always say, well, man, what if my grandparents, they used to live off the interest, right? Well, yeah, but they were probably getting, 5, 10, maybe even 15%, maybe on certain CDs, or at least 10% for sure, right? So when you look at things now, it's a little bit more complex, and you typically got to put a little bit more into the planning side of things to look at how is this going to be sustainable over a 5 or a 10 or maybe even a 30-year time frame, and looking at how that works. Now, the other thing, Ron, is a lot of people don't realize is a lot of people's wealth today is tied up in their primary residence as well as in their retirement accounts, right? So their IRAs, their 401ks. And I always tell people the crazy part is in their IRAs, they're going to have what's called an RMD, right? So a lot of us that are getting older, maybe we're 75 or 80 years old, maybe even 85 years old, that RMD gets rather high, right? It can go up to 5, 6, 7, 8, 9, 10%. And so now you're having to withdraw more and more money to pay tax on it. So that, simply I'm just going to put my money in safe places and live off interest. It does get a little bit more complex, and there's a lot more planning that goes into it. And I get the thought, Ron, is, I want to leave behind a legacy. I don't want to touch much of my money. Well, that's great. There's a lot of different ways to plan and prepare to do that, but it just might take a little more planning than simply just living off the interest.
Yeah. Here's another one for you. I'll be in a lower tax bracket once I retire. Is that wishful thinking?
It's crazy, Ron. Yeah, right. I would say some people, we're very, you got to think of things. There's millions of people that retire. Some people will be in a lower tax bracket. That's for sure, right? Some people are going to retire. They might have I have a client right now. They're making around $300,000 or $400,000 a year, and they're going to be able to retire in they're actually going to go out next year, and they're going to be making about $150,000, right? Which is still a pretty good retirement income, but it's dramatically lower as far as taxes go, right?
Yeah.
And so they're going to be in a lower tax bracket. So that's great. But there's some clients out there that I've seen retire where they're going to make, they're making $150,000 to $200,000 a year right now. And when they retire, they're still going to be making $150,000 to $200,000 a year. And so when you think of things like pensions, Social Security, IRA distributions, 401k distributions, all of that stuff is basically going to be lumped into, pretty much taxable. So it's something where you look at a lot of our income in retirement is still going to be taxable. And that's why a lot of, tax planning now, maybe Roth conversions or even funding Roths along your working career might be a benefit to you to try to help mitigate some of that taxes in the future. But there's a big chance that a lot of us out there are going to be in the same or higher tax bracket in retirement. And the biggest thing is, what if tax rates go up, right? If tax rates go up in the future, we're going to be even more in a pickle down the road because we didn't alleviate some of that pressure while we could. So it's not something I would say automatically, you're going to be in a lower retirement tax bracket, because we don't necessarily know until we run the numbers.
And most of the people say to you, I want to maintain my same lifestyle, or maybe it might even be more expensive. They might want to do a lot of traveling and all this sort of thing that they couldn't do while they were working. And, that's going to require a pretty big income to do all those things.
Well, that's exactly what I was thinking as you were saying that, right? Everything you basically mentioned is cost money, right? Which means we're taking distributions from something in the income plan, and again, for most of us, it's out there. It's from 401ks and IRAs. They're going to be taxable, so we got to really look at how to manage that.
Here's another one, and this is probably a pretty common thought with a lot of folks out there. We don't need to worry about assisted living expenses down the road. We're committed to taking care of each other, right?
Yeah, I always say, it's great if you can take care of each other, but the biggest question to ask is what happens if you can't, right? And that's a big a big bridge you got to cross, because the chances of one of you having, pretty bad health as things get older are pretty high, right? I mean, unfortunately, I do actually have some clients that are, well into their 90s and they're together and happy and everything's okay. But a lot of people, when they get into those late 70s and early 80s, you start to see one of the healths, sometimes decline and sometimes seriously decline. And so that's not a long-term care strategy, right? That's just kind of a long-term care hope is what I would call it, right? It's something where you're just hoping everything goes your way. And I always tell people of 100, let's say you're 70 years old or 80 years old, you could probably agree that everything in life didn't go 100% your way, right? And so it's just kind of, to me, not great planning to hope that, hey, this is going to be fine. We're both going to live together and take care of each other as long as we live. It sounds really great and and all that, but the problem is health really does set in, and there's going to be a lot more needs and wants that are going to come along that you're going to have to plan for, and that's why long-term care planning is, in my opinion, one of the most underrated parts of planning, because it's something it doesn't sound fun, right? Everybody likes to talk about what stocks you got, what type of an annuity you got, or what type of mutual funds you should use, but not a lot of people like to talk about what happens down the road when I have to go into some type of long-term care facility. How do we cover it? What's the best way to pay for it, and how do we plan for it?
And a really sad thing about, one person taking care of the other if that person gets sick. I mean, oftentimes the caregiver's health declines dramatically just having all the stress and all the work having to take care of this person.
Yeah, I've seen that time and time again. Like you said, Ron, that's a very good point you brought up. It's something where more often than not, it's the one that's taking care of the one that's not in great shape. The caregiver is the one that experiences either a big fall or you see their health decline dramatically because of having to exert so much extra energy and time and care into keeping the other person going.
You're listening to The Financial Beat with Logan Sadler, and Logan's number, if you'd like to call the office, 888-823-PLAN. That is 888-823-PLAN. You can call that number today. You can call right now during the show, in fact, and leave a message with your name and phone number, and you can arrange to have a discovery meeting with Logan Sadler. No charge whatsoever. We're talking about wishful thinking on today's show, and some people say, I'll spend less money once I retire because I'm not going to be burning gas by driving to work every day and eating out for lunch all the time. Well, that may be true, but there are other expenses that are probably going to take the place of those.
Yeah, you're right. Like we were kind of talking about earlier, Ron, just a few minutes ago. What do people envision? That's one of our first questions, right? Is okay, what do you envision retirement like? Almost all the time you hear travel, right? You hear maybe going to see the grandkids, spoiling the grandkids a little bit, time with friends and family, being active, right? A lot of that stuff costs money, right? So, I mean, let's be honest. What do the statistics show out there? Most people spend more money on Saturday and Sunday than any other day of the weeks, right? Because why? Because we're home, right? And we could spend money, right? If we want to go golfing, we go golfing. Want to go eat something nice, we go. If we want to buy something nice and go to the department store or Costco or wherever it is, we got the time to do it, right? And so retirement is basically a 20 or 30 year stretch of Saturdays and Sundays, right? So you got to really be disciplined. And I've seen people spend way too much in retirement. Sometimes I've seen spending dramatically increase in retirement because people join a lot of social clubs and things like that, and keeps them rather busy, a lot of traveling. And so you got to kind of map out your spending, because there is spending peaks, I'll call it, where, certain times in retirement, you'll spend more money on fun trips and things like that. And then there's certain parts of retirement where those types of spending go dramatically down. But now we have other costs, like we were talking about earlier, like nursing home, long-term care, things like that, where stuff like that can go up. So you really got to take a look at your spending and really kind of, again, envision how you envision that next phase in retirement. And that'll give you a pretty good idea of how you got to get your income plan to support the desired lifestyle, to where you're not just hoping, I make $100,000 a year, but I can get by off of 50 if I had to, right? Well, when have you ever done that, right? So you want to make sure you're able to put yourself in a good situation to where things are realistic.
Well, here's one more scenario I wanted to mention here, and some folks may have gotten in trouble, a lot of trouble, like a couple of years ago by having this mindset. They say, I've gotten a nice return on my investments for the last 10 years or so. If I could just keep getting a similar return, I'll be just fine. I really feel sorry for the people who went into retirement a couple of years back and with that kind of mindset, because that's really troublesome.
Yeah, you're totally right, Ron. I mean, I think, just throwing out some dates here. I mean, basically from 2013, 2012 or so, all the way through basically up till the COVID pandemic, we had a great market run, right? Which is where, we saw a lot of different industries and sectors appreciate over time, which is great. We saw a lot of 401k balances rise, a lot of IRA balances, things like that, which is great. The problem is, Ron, like you were saying, a lot of people get very overconfident very, very fast, right? They forget about those 10 years, maybe from 2000 to 2008, that were very, very bumpy, right? They had a lot of turbulence in them, and they only remember the last 10 years of the good times, right? And so when you're building a financial plan, I've actually had clients that have came in and again, what we do, we specialize in retirement planning. So most of our clients are typically, 55, 60 years old, maybe 65 years old, and they're coming in and getting a game plan together for retirement. And sometimes they're just kind of interviewing us and seeing if we're a good fit. And it's funny because I've had some clients or some prospects that come in and interview us say, I got $1 million and I've been averaging 10% over the last few years. So I'm pretty sure I could just take out, 10, 12% and I'm going to be just fine, right? I mean, if the market's returned that over this last few years, I'm going to be just fine, right? And the biggest thing, Ron, is like you said, you have a few of these bumpy years like we've had, and all of a sudden that retirement plan doesn't seem as bulletproof as it did before, right? Yeah. And so that's why when you're building out that retirement plan, you got to look at a lot of different income streams. A lot of people want guaranteed income, right? Things like annuity payments, Social Security, pensions, as well as you want other things that are, market-based dividends, things like that. But the biggest thing, Ron, is a lot of people aren't aware of how volatile that investment plan we talked about could be, right? And so I think one of the biggest things that we offer as part of what our firm does is, when you come in here, it's not just, hey, here's some mutual funds you should buy, or here's something you should buy. A lot of the times it's really, let's look at what assets you have. A lot of our clients got, some of them got 300,000, some of them got 3 million. And so you really put together a game plan and go through the strategy of building out that retirement plan and the income plan that's going to support your lifestyle and making sure that it's going to be there to last. So if you're one of those people out there, again, been listening to the show and interested in that discovery meeting, and you're one of those clients, again, that's maybe approaching retirement or just starting and looking for a way to get you a plan that's going to get you to and through retirement, go ahead and give us a call. I'd love to sit down and spend an hour with you.
888-823-PLAN, 888-823-PLAN. That is the number to call for Regari Financial. In Southern California, there are 2 convenient offices, Redlands and also Hemet. But you can get a discovery meeting on the phone if you like, or maybe with a Zoom connection with Logan Sadler, the same guy you hear on this show every week. 888-823-PLAN is the number to call if you'd like to make that happen. 888-823-PLAN. I'm Ron Stutz along with Logan Sadler, reminding you that Logan works with 3 different generations of client families, and many of those clients have been with this firm for more than a quarter of a century. Would love to work with you no matter what your age. 888-823-PLAN. We'll be back with more in just a moment. You're listening to The Financial Beat.
At the end of the day, no one truly understands your financial wants and desires better than you. That's why it's important to have financial independence. This means you can work when you want, you know exactly where your income is coming from, and most importantly, your finances are stable. If this sounds like something you want, well, text the word advice to the number 21000, and Logan Sadler and his team at Regari Financial can provide you with their free guide on achieving financial independence. The free guide will show you how to create an action plan for getting to where you want to be. It'll explain how to calculate a financial independence goal, and it'll define what an ICE egg is and why it's so important. Download it now by texting the word advice to the number 21000. Again, text the word advice to the number 21000 to gain your financial independence today.
Did you know music is good for the heart? A study at a university in Italy showed that music helps promote a better cardiovascular system. But we also know that a sound financial plan is good for peace of mind. Keep listening to The Financial Beat so we can help you find a plan that both your head and your heart can agree on.
We're back now with more of The Financial Beat, starring the one and only Logan Sadler. 888-823-PLAN. 888-823-PLAN is your number to call if you'd like to get in touch. Maybe you've been listening to the show for quite some time now, and you just haven't gotten around to making that phone call. It's so easy to procrastinate, but don't do it. Go ahead and call right now while you're listening to the show. That's fine. Call, leave a message with your name and phone number, and you'll get a call back to make it happen. 888-823-PLAN. Hey, Logan, we appreciate all our radio listeners, but there are folks out there who listen to you every single week in another way by checking out your podcasts. And how many of those things you got going now?
Yeah, it's crazy. I think we just did our over 100th episode now, so we're rolling now on podcasts. So if you haven't yet, go ahead and check out the show over there on the podcast platforms, Apple Music, Amazon, wherever it is you download podcasts. You can check it out. Again, over 100 of them now up there for you to go check out. So don't got to listen to them all in one day, right? You can spread that over a few weeks, but some good stuff for you, as well as we got the YouTube channel that we love doing. It's good, short educational videos. Some of them are 3 to maybe 5 minutes long, and they're on Roth conversions, how to assess risk in retirement, Social Security, when's the best time to take it, and what considerations should you have, right? A lot of those conversations that we actually have right here on the radio show, but we're able to slow them down a little bit on the YouTube platform and go a little bit more into some visual effects. So head over to the Financial Beat on YouTube or on podcast and check those out.
Yeah, there's some really helpful, informative stuff there, and it's not boring either. So, I promise you, go there, check it out, and you'll learn a lot just by seeing what Logan has to say. And let's check out the financial dictionary, and I'm going to leave it to you to explain this term so that people understand what it means, but not to give us an explanation so incredibly in-depth that people are falling asleep and driving off the road. So, how about full retirement age? How would you define that?
Yeah, what's funny is there's a big kind of sometimes a misconception on that. Now, what full retirement age is, typically that's calculated on pensions and and Social Security. Now, what a lot of people say, well, who is the government to tell me my full retirement age, right? And basically what that means is it's only on, let's just use Social Security for example. A lot of people say, well, my full retirement age is 62 because that's when I could retire, right, and start collecting the benefit.
Yeah.
And the answer is no, right? There's actually a different alternative. You could take Social Security at 62 and you could let it sit till 70, but there's also what's called a full retirement date, right? And it's really kind of dependent on when you were born and all that. And actually on your Social Security report, you can run one that says full retirement date. For some of you out there, it might be 66 and a half. It might be 67 and 3 months, right? It's always a different number based off your date of birth. And so what you could do is you could actually run those, and that'll tell you when your full retirement date is. And basically it's a way to maximize the situation. Again, there's different pensions that have a full retirement date and vesting balance on it where you could look at those. And it's basically a way where you're optimizing your payment by waiting until that date. And then it does sometimes go up from there, but that's kind of like, okay, peak earnings, right? When you're ready to go, that's kind of like the best time for most people to take it, as well as there's some other tax considerations and things like that. But long story short, Ron, that is full retirement age.
Yeah. Thank you very much for explaining all that. And anybody have any more questions about that, you're certainly welcome to call Logan Sadler and have that be your first question in the discovery meeting, and he'll be glad to explain it all over again. We've talked about market corrections earlier in the show today, and I thought it might be helpful to talk about different reactions to market corrections that people follow through on. Anytime the market moves in a downward direction, it's certainly done a lot of that in the last couple of years, we see people react in various ways. What advice would you give to people who have some of the following reactions during rough periods in the market? How about the people who resort to over trading? What would you tell them?
Mm-hmm. Yeah, and first off, with market reactions, everybody's so different, and you really should be meeting with an advisor and making sure you're getting, a situation that's going to be exactly to you, and make sure you're getting the correct advice. And like you said, Ron, though, there's a lot of different ways this breaks down. One of the more common ones, like you said, is over trading. Now, what would I tell somebody, or what are some of the characteristics of reasons not to do that? Is looking at, a lot of clients, as they see markets get volatile, what they do is they say, well, I'm going to sell out of stocks today, and I'll go to bonds today, and then I'll go back in 2 weeks when the market stables out, right?
Yeah.
And we see that a lot where people are trying to constantly trade and be very active. And here's the problem, right? Let's look at 2022, for example, was a great year to look at, where a lot of people's equity portion, right, which stocks and things like that, was going down pretty good. And what they were doing is, I had some clients that were trading out a lot of money and instantly moving it over to bonds. And now, a lot of the bonds they were in were actually going down pretty close to what their equity portion was going down, right? And the problem is a lot of people don't think bonds will rebound quite like equities do. So then again, you're selling off an investment that was going down and buying into another investment that was going down almost just as quick, right? So sometimes you got to really make sure what you're going into. Now, there could be different trading algorithms and different strategies out there where it might be a good active portfolio that trades efficiently that way. But more often than not, a lot of the times, more of the trading during those times is really less efficient than just staying put, of course, just depending on your situation.
Yeah, and a lot of these people are just, this over trading business is, trying to outsmart the market and constantly moving your money around and everything, and that can get you in some trouble. How about the people who panic when the market goes down? They're constantly worried that market losses are going to lead to absolute financial ruin. How do you help those folks?
Yeah, you're right, Ron. I mean, some of the people I meet with, if the market goes down, it's like the worst day of their lives, right? I mean, it's something where it really emotionally affects them, and it really makes them look at things differently when the market's down, because you got to be realistic. A lot of things are running through their head of, man, am I going to be able to retire? Am I going to run out of money? Am I going to be able to leave any money behind to my kids? A lot of those things are going to go through your head, and I think that is all the more reason to have a good retirement plan, to making sure you're kind of lowering that risk of constantly worrying about market losses. But when you look at panic, you got to look at things like, people that I meet with. I'm very big on looking at history. I'm very big on looking at diversification, and I'm very big on planning. And so I think those three things tend to help a lot of people look through things and again, realizing what type of risk they're in. I think that's something where you need to understand what type of investments you're in and what types of ups and downs those can experience, because what that does is it gives you some peace of mind knowing, hey, you know what, this has happened before with the risk tolerance I'm in, and it's came back in this amount of time frame roughly, right? Or I'm way too aggressive based off the risk tolerance questionnaire. I need to reduce risk, look at other safer alternatives and things like that, because you don't want to have a portfolio where you're constantly panicked and looking at the market, right? I have some clients where I met with in the past where they say, man, every day I've been waking up and looking at my 401k statement. I look at it every day. I go online and I'm worried that this is going to be it, right? And I always tell people that's no way to live a life, right? Whether it's retirement or pre-retirement, you want to make sure you're doing a lot of that legwork, and working with a good advisor can help alleviate a lot of that, where you have a full financial plan and you understand that some assets might be more volatile, some assets might be completely safe, and some assets might be, more longer term. So you kind of want to structure things sometimes where you are able to kind of lower that overall panic, because you don't want to wake up every day panicked about your investments, because it's just not going to be a very good retirement or pre-retirement, and you run the risk of buying or selling more often than not because of the panic you're worried about.
A lot of people just react in an opposite way. Maybe they have the ostrich effect, and by that I mean they just stick their head in the sand and try to ignore the bad news. They try to ignore everything, and sometimes don't even open statements when they come, because it's depressing to look at it. You've met people like that, haven't you?
I have. I was thinking, like, man, you're talking about a few people I know here or I've met with. And it's funny, Ron, because there's some I'm a big believer in the long-term approach. You got to look at things long-term. You got to be very realistic about stuff. But there's also the complete opposite, like you were saying, where, I never look. I just keep my head down and hopefully it comes back up. And I go, are you pretty aggressive? Are you retiring soon? They'll go, yeah, I'm retiring in a week, right? And you're like, whoa, okay, you might want to reassess the risk, and it might be time to undig that head from the sand there and start looking at things, because there's a balance there you want to find of thinking long term, but also you got to be very realistic about what assets you have, what investments you're in, what the return risk is on those, as well as are we needing income really, really soon, or are we needing income in the future, and start looking at things like that, because you want to find a balance between not getting too panicked, but also to where I haven't looked at my account in 5 years, right? Hopefully it's doing well, right? You want to kind of find the balance there. And again, a good advisor should be able to help you find the balance there.
You're listening to The Financial Beat with one of my favorite people, Logan Sadler. If you'd like to get in touch with Logan to get a conversation going, we call it a discovery meeting. 888-823-PLAN is your number to call to make that happen. Won't cost you anything and won't carry with it any kind of obligation. We're talking about different people and how they react to market corrections. Some people react with extreme confidence. They don't show any signs of worry about the market ever, because it's going to come back eventually, and so they don't tweak, they don't change anything at all, and they just think everything's going to work itself out, and that's not always the case, is it?
No, it's not, right? I mean, you look at the market. I mean, yes, it's a very good typically a good place to have money, especially looking longer term. The problem is things change, right? And your situation might be changing. If you're 30 years old, I would tell you, chances are you're probably in a pretty good spot if you're in some good funds or good investments. And over the long term, probably will come back. But there's some people out there that are, if you're 55 or maybe you're 60 or 65 and you're getting ready to start retirement, the chances of things being a little bit too aggressive and the market going down and things not coming back as well as they could have is a very real possibility, right? Because you look at a lot of us as we start retirement, we start taking withdrawals, right? We start taking income. And so what that does is that changes everything when it gets time to the income phase. Because let's say you have $100,000 in an account, Ron, and it goes down 20%. Okay, right? A lot of us might have seen that before. We might be okay with that.
Yeah.
Now the problem is we still need income off that money. So let's say we're taking an additional 5 or 6% out per year. Now we're down, closer to 25 or 26%. And if that market stayed down another year, right, we're down an additional whatever we're taking out. So now let's say we only got, market dropped 20%, so we had 80,000, took some money out. Let's just say for fun we had around 70 or 75,000 in there. That market needs a way bigger return just to get back to even now, right? You don't need just a 20% return to get back up. You need way more than that because now we have less money in there to compound on to get it back up, right? So a lot of us that are getting closer to retirement or maybe starting retirement, a lot of your investments need to change. And I have some clients where they'll be like, well, I don't want to be ultra conservative. I've never been that type of investor. And I'm not saying you have to. I'm saying you got to look at your overall plan and see kind of what fits. And there still might be plenty of room to leave some things as is or as you like them, but it might be time to take portions of your money and start structuring them for income and different diversified assets to where you have some protection because, again, those volatile spells during the market downturns can be very, very hard to come back from, especially in those income years and retirement years.
Logan, I want to mention one more reaction here that some people have to a down market, market timing. I mean, they try to pull money out, sit it in cash at just the right time, and then try to get it back in at just the right time to ride the market back up. And, the problem with trying to time the market, as we have said so many times, is you got to be right twice, when to get in, when to get out, etc.
Yeah, it's not easy, Ron, right? Basically I don't want to say it's impossible to do, but it's very, very, very uncommon to do, especially twice. Like you said, you got to get out at the good time and get in at the good time. And here's the funny part about it is it sounds really good when you're talking about it, but the more you look at the numbers and look at graphs, I'll show people this. Here's why you don't want to do this, right? And the reason is, let's use an example, right? The market is, whatever, you got 100,000 again, an example. Market goes down 20%, then clients go, you know what, I'm going to pull out and wait for the market to stable out. The market goes back up that 10 or 15% or 20%, and then we say, okay, the market's stable, let's get back in, right? But you're still down, right? Because you didn't leave portions of it in there or any of it in there probably.
Yep.
And so it's just very, very inefficient. Now you have some people that say, hey, next month's going to be a bad month, I'm going to get out ahead of time. Well, then, heck, who knows? The next month could be a great month, right? It could be record breaking or it could be a down month. But the hardest part of Ron is just trying to say, you look at all these people on the news, all these different articles out there, and I read a lot of it. And, one of them will say the market's crashing tomorrow. The other one says the market's going to be the best it's ever been, right? So you got to look at things and understand that not all those news stories out there are pertaining to your situation. And I think one of the best things about financial planning that we love about it is it really is so unique to your situation based off your time horizon, your goals, your hopes for the portfolio and income and things like that, and how you envision that retirement plays a huge part in how you should be invested and how your plan should look. And I think that's one of the things our firm has done well for a very long time here and have a good track record of is not trying to time and pick the best day to be in the market or to be in the best investments at this day, but looking at how can we do this very efficiently over your 20 or 30 year time frame of retirement to make sure it gives you that peace of mind you need in retirement. Because again, most people when they're retiring, they're looking for that next paycheck, right? They're looking for that next peace of mind to transition them into retirement to where they don't have that volatile and scary retirement. So I think that's what we do a lot is help people provide that sound peace of mind and looking at the overall concept of what they need in their plan to get them to where they want to go.
888-823-PLAN. That is 888-823-PLAN. Your number to call if you'd like to have a one-on-one conversation with Logan Sadler. I get a chance to talk to Logan every week on this show, and if you'd like to experience that, then you can do it on the phone or via Zoom or maybe in one of the offices for Rigary Financial. It's not going to cost you anything at all for a discovery meeting. That's where it all starts. 888-823-PLAN. No cost, no strings attached whatsoever. Why would you not take advantage of the opportunity? 888-823-PLAN. We appreciate your listening to the radio show, the podcast, the YouTube videos, and there are lots of ways to get information from Logan Sadler. One of those face-to-face, if you'd like to have that meeting, 888-823-PLAN is your number to call to make it all happen. We have some great questions from some of our listeners coming up in the next segment of our show. Hope you will stay with us for just a moment here. You're listening to the Financial Beat.
Don't you want to see sharp and not be flat in retirement? This is the Financial Beat.
We're back now with more of the Financial Beat, starring Logan Sadler, the Vice President and Chief Investment Officer at Gary Financial, serving you in Southern California. Hey, thanks for being with us today. My name is Ryan Stutz. Always fun to get questions from our listeners. We'll get to those in just a second, but let me remind you, Logan Sadler's phone number, 888-823-PLAN. That is 888-823-PLAN. Call that number right now during the show. You don't have to wait. Call it during the show. Leave a message with your name and phone number. You will get a call back from the good folks at Gary Financial and set a time to have your discovery meeting with Logan Sadler, the same person you hear on the radio show. And I guess you can probably tell just by listening to the show, he's a really nice guy, easy to get along with, not going to be any pressure, any salesmanship, any of that stuff at all. Just kind of a getting to know you session. 888-823-PLAN is your number to call to make that happen. First of all, before we get to these mailbag questions today, Logan, if there are folks out there who have specific questions that they would like to get to you and maybe have those questions answered here on the radio show, how do they get those to you?
Yeah, great question there. You could actually go onto the podcast platforms or even on the YouTube platforms. I've had a couple people on there now suggest, hey, do this topic, right? So we'll do them on there, as well as you can call into the show and like Ron was saying on that number there, and it's actually a voicemail. And you could leave some questions on there as well, or if you wanted us to answer them on the radio show or YouTube platform or whatever it may be, we could definitely get those answered, because it's always one of our favorite things there is to see what information you guys have questions on and bring that to you. And
you don't have to worry about us revealing your situation here on the radio show either, because we always change the names to protect the innocent, as they used to say.
Yes, we do.
First question today is from Sally, and Sally is sending this question from Arizona. So Sally says, I'm retiring next month, and it occurs to me that I don't really know where my income is going to come from. I'll have Social Security, but that's not going to be enough to live on. Should I just start withdrawing from my 401k next month when the paychecks stop?
Okay. Yeah, great question, Sally. So it does sound like you definitely need to get with the financial planner here, I'd say pretty much immediately, right? Where typically that's what you want to do beforehand, right? You want to go through, okay, what assets do I have? What of them can be used for income? And is that going to be a sustainable income? And is it going to be enough income, right? So, it looks like you're coming up here pretty darn quick on retirement. Yeah. And like you said, Social Security is a great asset, but it's not typically enough to live on, right? And so that's where you look at things like 401ks and IRAs. You could use them as income producing vehicles in either the market, right? There's a lot of good market strategies out there with, mutual funds or ETFs or stocks that can produce some good incomes. There's also annuities out there that are a great way to help, supplement with like a pension type of thing where you could put money in there and it will pay you a guaranteed income stream as long as you live. Those can be great as well as some other things, but you want to make sure, how much do we have in the 401k? How much do we need to keep liquid? How much do we need for growth? And how much do we need to use for income is really something I would kind of help structure out and look at, because it's going to be important. You don't want to take too much out of the 401ks in certain years, because it might be great for now, but you might run a lot higher risk of running out of money. So you want to make sure you're looking at that correctly, and that's something a good financial planner like us would be able to help you calculate and implement there. So definitely give us a call, and I don't normally say this, but as soon as you can, because you're definitely running a tight ship there on time frame there.
Yeah, she's retiring next month. I mean, it's way past time to have this conversation for sure. So, yeah. hey, Sally, here's a number one more time. Please write this down: 888-823-PLAN. That is 888-823-7526. Very important. Have a conversation with Logan Sadler before you start making all these decisions. And next question here is from Martha in Orange County, a little closer to home. Martha says, I turned 73 at the beginning of the year, so I'll have to start taking money out of my IRA this year, even though I don't really need it. Can I just take it out and reinvest it back in something else?
Yeah, so great question, Martha. And so my favorite way to do this, especially on the radio show in person, I kind of do this on a drawing. Anybody that's came in and met with me or on Zoom or whatever, I'm pretty good at these really bad drawings. Good visuals, but horrible penmanship and drawing on there. So basically, let's draw two boxes, right? So draw one on your left side that's taxable, right? So write 401k on it, it's taxable. And then write one on the right that says non-taxable, right? And so basically, anytime money goes from the left bucket to the right bucket, it's going to be taxable at income rates, right? Especially if we're talking about traditional IRAs and 401ks. So let's say your RMD is $20,000 a year. You could take that $20,000 out. You'd have to pay taxes on it, right? So maybe now after taking 20 out, maybe you withheld and you only got 15,000 now, right? So yeah, you could take that 15,000 and put it in a non-qualified brokerage account, an annuity, a CD, anything you wanted to put that into that fit your investment risk and your plan, you can do, but you do have to pay taxes on the RMD. That's the only thing where some clients think, I could just reinvest it and I wouldn't have to pay taxes, and that is not true. You do have to pay taxes. So again, draw those two buckets, anyone that's taxable. Anytime it comes out of one bucket and goes to the other bucket, there's going to be an exchange where Uncle Sam's waiting there in the middle saying, all righty, give me some of my taxes, right? So it's something where, that's why I love those visuals. It gives you a very clean and simple picture. But yeah, you definitely can reinvest it. I have tons and tons of clients where, their RMD is $20,000, $50,000, $40,000 a year, and they might only use, they might not use any of it, and some of them might use a little bit of it, and then we reinvest the rest. So there's definitely ways to do that, and I would be happy to walk you through that.
All right, great question, Martha. And since you just turned 73, that's going to take a little planning when you have to take out those RMDs. So good thing you asked that question of Logan. And again, if you want to talk to him more about that, call the office and set up a time. Next question here is from Thomas in Fallbrook. Thomas says, I was recently diagnosed with ALS, so I'm retiring at 53 to spend as much time as possible with my wife and college-age son because I just don't know how much time I have left. I have some life insurance, but what else do I need to think about to make sure my family is in good shape financially after I'm gone? Wow, tough question.
Yeah. Wow, that is a tough one. Unfortunately, I've seen this a few times, where I always say there's a situation out there, we probably have seen it or something like it, and this is one of those unfortunate ones where we all know things or people out there where stuff like this can happen, and our thoughts are with you on that, Thomas. But as far as your question goes, one of the biggest things I would say is, like you said, I'd really look at all your life insurance, bring out all those documents, look at all the assets you have, liabilities you have, and a good financial plan to kind of help put all the pieces together of where what all assets we have, our estate planning, everything like that, and just making sure our total picture is as put together as we could possibly get it for, when something finally does happen, we have everything kind of put together, because like you said, it's definitely something where something like this comes out of the blue, but it does give you sometimes a little bit of time to get things in order and get things planned. So I definitely start looking at what assets you have, what liabilities you have, your family, and kind of looking at all those avenues. And again, something we have some experience in, so give us a call. I'd love to kind of walk you through where we would kind of go start at and where we would go. But, again, our thoughts are with you on that one.
That's a really cool thing about being in this business for quite some time, Logan. I know that you've seen other scenarios with people who are in very similar situations, and you're able to learn from those, and you were able to help those folks, and then you can pass that knowledge on to the next person who comes in with that same situation. Logan, yep. I know a lot of people out there have been listening to the show for a while and haven't gotten around to making the phone call. It is very important to go ahead and call that number now. Logan, what happens when you first talk with someone in that discovery meeting?
Yeah, the best part about our process is we try to make it as easy as possible, but we also like to make sure that it's very thought out and very, it allows us the time to customize it for you guys. So basically how everything starts is you call the number Ron gives you, and basically you leave a message and you tell us your name, your phone number, and we get someone from our offices gives you a call back first thing Monday morning, and they get you scheduled for in person or Zoom or whatever is more convenient for you. And we typically spend about an hour where we'll go over, what your situation is, what your time frame is, what your goals are, and we really go over a lot of, yes, we talk money and financials and all that, but we go over a lot more of, about you, right? You and your family and what your kind of goals and dreams are. And that allows us to really look at things from a personal end and a financial end, right? And making sure we're able to kind of tie all those pieces together. And in our discovery meeting, we always tell people, hey, you don't need to bring your checkbook, you don't need to bring a pen or any of that stuff. It's basically just a discovery meeting to get a chance to get to know one another and look at your situation. Number one, to see if we're even a good fit, right? Because not every client's a good fit for our firm, and we're not a good fit for every client, right? So it's a good idea for us to kind of just get to know each other, see what your situation is, and then if we're a good fit from there, what we do is we go on to our second meeting, where then we'll have strategies and recommendations and things to discuss. But I always tell people that discovery meeting is just a great time for, if you're one of those clients, like I said, if you got $300,000 or $3 million and you're getting ready to start planning for retirement or getting close to that date where you're going to pull the plug, or maybe you just did, I think it's definitely a valuable phone call for you to reach out to and schedule that time, because again, I'm pretty sure we could add some value to your plan and your retirement, whether you decide to move forward with us or not. Just a good introduction and good getting to know you session.
888-823-PLAN, 888-823-PLAN. That's your number to call for Gary Financial. Logan Sadler is the VP and Chief Investment Officer, and there are two convenient offices, one in Hemet, one in Redlands, and of course he meets with folks all the time, either on the phone or via Zoom. These days technology makes it seem like you're sitting right there in front of him. So
Yes,
hey,
it does.
888-823-PLAN is your number to call to make it happen. A discovery meeting can be yours absolutely free without any obligation attached to it at all. 888-823-PLAN. You've been listening to the Financial Beat. I'm Ron Stutz along with Logan Sadler. Logan, it's been my pleasure, as always.
Yeah, Ron, I appreciate the hour you spent with us, and I appreciate all the listeners out there that have given us all the support these last few years on the show and the content we've been creating, and hopefully you guys find it valuable. Again, we can't meet with every single person in the world, so it's great to be able to give this content out and education, and I look forward to being back here again next week and continuing that.
Join us again next time for the next edition of the Financial Beat, and then the beat will go on.
The information provided is for educational purposes only and is not intended as investment advice for anyone. All information discussed is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of BD Financial Group and do not necessarily represent the views of Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, tax, or legal advice. Please consult with your financial professional before executing any financial strategy. Investment advisory and financial planning services are offered through Alpha Star Capital Management, LLC, an SEC-registered investment advisor. Alpha Star and BD Financial Group are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.